Please welcome the panel on Credit Trends and Private Credit Evolution, moderated by U.S. investment editor at the Financial Times, Eric Platt.
Good morning. Welcome to the Milken Conference. I'm Eric Platt from the Financial Times. We're joined this morning to discuss global credit markets, which are at a fascinating inflection point. We've seen a new group of competitors deploy hundreds of billions of dollars over the last 5 years, and I'm talking, of course, about the private credit industry. Giants like Ares and Apollo are really starting to drive terms and elbow out traditional banks. It's an interesting point, and I think, especially given we've got a slowing economy, and companies are starting to struggle with higher interest rates, it raises questions about whether private credit lenders are going to struggle with portfolios, or if this is actually going to filter in to traditional credit markets. I'm joined by a really esteemed panel. We've got Greg Brailovsky of SVP, Anne Marie Fink of the State of Wisconsin Investment Board, Steve Kuppenheimer of Lord Abbett, Brad Rogoff of Barclays, and Kevin Sherlock of BMO. Brad, I wanted to start with you. There's been a presence at this conference that's been hard to ignore, and that's U.S. Treasury Secretary Scott Bessent. It seems he's trying to calm markets. He's trying to really put out the idea of what the Trump agenda is for the economy. I'm wondering for you what this means for credit and how credit is responding really to the tariffs since they were launched in April.
Yeah, well, I mean, look, I guess he's doing a good enough job calming markets if we look at where we are today versus where we were in the beginning of April, or say April 2nd, right after that. So, if we look at where credit markets are, there's been a lot made of how much we've rallied back in equity markets. We're not quite there in credit markets, right? We're still trading much wider, or a decent amount wider than we were at the tights of this year. Now, some of that is consistent with really the breakdown of what's happening in equities, which is being led by a rally in the NASDAQ, being led by a rally in tech stocks. And if you look at something like high yields credit, right, and you look at that versus the Russell, it tends to make a little bit more sense, which is kind of not back to those highs. But all that said, if we take a step back and say where are credit spreads today, they are clearly nowhere near what you would consider recessionary type levels, right? And so if that concern has increased, and we certainly think it has, we think, we're in a base case of a very modest recession would be what our economics team would say. You look at investment grade credit spreads just north of 100 basis points, high yield credit spreads around 350 basis points. You would expect, for example, high yield spreads, average spreads are 450, approaching 500, depending on how you want to look at it. And so, the market's responding pretty well, right, to this pause and let's see what develops environment. And I think the last thing I would add is I think credit markets are also responding similar to the way broader economic markets are responding, right? Which is that hard data, good, soft data, not so good. And the way credit markets are saying is, look, we just had an earnings season. It's pretty darn good. I don't think anyone on here is going to argue with that. Was guidance pulled from some companies in certain industries? Yes. But I actually think it could have been a lot worse. So I think that wait and see approach is persisting.
Right. In live-in markets, how are people thinking about defaults going forward? We've seen S&P and Moody's start to raise their forecasts for defaults going forward. How does that trickle through? And I should also pose this to Steve and to Kevin. I'm wondering what this means for your underwriting as you're going forward. Like, is there different risks you're starting to take into effect when you're doing bridge loans or if you're underwriting a new private credit deal?
I think absolutely there's a different point of view. I think that in general, private lending, you have to assume you're in the credit until maturity. So you look at liquidity differently in the form of cash flow, in the form of likelihood of repayment early. But I think you have to underwrite to maturity, which is often 6 or 7 years. And so in a scenario like that, you're going to assume an economic cycle during your hold period in general. And I think in today's market, interesting, Brad's comments on the observations of the liquid market. Private markets, maybe a little bit different, but similar. So you saw kind of an immediate pullback. I think the impact in private markets when you have a volatile event is to slow down or stop deal activity. That's kind of the first thing you see. And then you've now seen that kind of come back, maybe a little bit wider. But interestingly, I don't think it's widened out on a percentage basis as much as the liquid markets have widened out. I think it's widened out modestly. Yeah.
Yeah, and when we underwrite, I think when most banks underwrite, you just always underwrite. We always have to underwrite to a default case scenario, right? So we look at it and try to stress it. So regardless of economic output, you always try to figure out like what would actually stress the model and create default. So we always kind of underwrite to that. Obviously, this market and this economy is a little tougher as you try to figure out, how are tariffs and policy going to implement that or impact that. The good news about the U.S. leveraged finance markets over time, and we saw this through the time frame in 2010 to 14 when there was peripheral issues in Europe and trying to figure out like what are these exogenous factors that might impact it. There are a lot of industries that are financed in the U.S. leveraged finance markets that tend to be fairly protected, right? So if you think about what we're doing now in infrastructure on data centers and underwriting, lots of capital to go into that. That tends to be mostly U.S. dominated. Healthcare, a lot of the consumer brands tend to be that are done in our markets tend to be very much U.S. centric. And so you try to find some of these cases where you're actually insulated a little bit. The bigger thing, obviously, we're underwriting to is just where the markets are. There's a bit of an inflection point typically. If the average trading dollar price for loans or bonds is 97 or so, people will buy new credits because you can kind of make the duration work and you can price that effectively. What we saw in the middle part of April where average bid prices moved to 95, it's hard to sell a new name. When someone can go back and say, I own this particular asset at par 99, and now the same asset that I've understood and owned and know for 3 years, I can pick up 3 points lower. It's not necessarily worth it for me to spend the time to do work on a new credit that I don't fully understand to get kind of the same kind of return. So that's really what we're looking at as we're underwriting right now. It's like we always try to look and see where the economy might go and stress that without any certainty about what that's going to be. So that's always just a probabilistic kind of view of it. But what we're really looking at now is just like the relative value pricing where you can buy stuff in the secondary market versus what we're trying to bring new. We're still pricing risk. It's just, this is one of those markets where everyone's like, oh, the banks aren't lending. We're lending at the prices at which investors want to borrow, and sometimes that just doesn't fully work for the models that the sponsors or even the corporates that are looking to acquire somebody. They kind of need the lower rates to make the investment work.
And to put a point on your question of like where default rates could go, look, I think in the same way that corporates aren't able to fully change their outlook quite yet, I don't think people can sit here and say, yeah, well, I was thinking 3 to 4% default rates, but you know what? The answer is probably going to be 7 to 8, but so I'm going to assume, after July 9th, the full tariffs go back on, and what does that do from a liquidity standpoint and the working capital across a bunch of different industries? I don't think we can conclusively say we're there yet, right? But certainly in a recession-type environment, yeah, you're looking at high single-digit default rates.
Yeah, are direct lenders being compensated enough, and even, I should say, lenders in traditional credit markets? I'm thinking of, there was a Citi deal recently for a Boeing unit that got sold to a private equity sponsor. There was fierce competition. I think it was S plus, in the 400s. Are they getting compensated if things take a turn in the economy?
I'm happy to take that. And I would say, I think yes in general, but I think the issue for the last couple of years has been not enough differentiated pricing. So the credits, if you're thinking about direct lending, you're generally talking about unrated credits, but they would map to kind of single B type risk. And in normal markets, or maybe historically, single B rating or that part of the market is quite broad in its actual quality and risk. And historically, you've seen pretty disparate pricing for credits in that space. So you might have a stronger credit that's priced, 1 to 200 basis points tighter than a weaker one. And that, I think, the last couple of years has been more muted than it has historically, really driven by less deal volume, as we're all aware, and a lot of capital formation in the space. So even over the last month, I think we're talking about average spread widening here, but one of the more encouraging things that we have seen is more differentiated pricing. So weaker credits actually gapping out or deals not getting done versus getting done and being very close to the stronger deals. And so on average, I think the spread and return, I think historically you can demonstrate it's far outpaced losses. And so from that perspective, I do think it's been sufficient. But on an individual credit basis, I think it'd be good to get back to more differentiation.
Perfect. Greg, I wanted to bring you into this. One thing we've seen, or if we are going to expect an uptick in defaults, I'm wondering kind of how SVP is going to play this. I'm wondering if you can play this in the direct lending space, or if it's still going to be traditionally in kind of public credit markets.
Yeah, so look, we're coming into this year, we were observing an economy that was running out of steam, especially in Europe. GDP growth in Europe was 0 to 1%. Germany was in a recession. US was doing okay overall, but certain sectors were under a lot of stress. So anything construction related, so think building materials, chemicals companies, consumers in US started to really weaken last year, especially the bottom half of the demographic. So we saw a lot of defaults in the consumer product space. So even last year with the overall benign economic conditions, we saw default rates in leveraged loan space, 5%. We think direct lenders had similar defaults as well. So a really unusual environment where you don't have a recession, the economy overall is growing okay, but defaults are really elevated by historical standards. And so now as we look at this year, obviously the changes in trade policy are creating significant volatility in a lot of sectors. Our expectation is the defaults are going to be at least 5% again, potentially higher. And so once we look through the cycle and think about what the cumulative default rate is going to be, it's going to be something like 12-15% over a 3-year period, which is historically very high. And then at the same time, the recoveries are historically low, right? The first lien leveraged loans recovered 40 cents over the last 2 years, which is about 25 cents below the historical average. So the actual stress, the loss given default is very elevated in the system right now.
Perfect. One thing we've written a ton about is just liability management exercises that we've seen in public markets. I'm wondering if those are shifting at all since we've had some major court case decisions out of Texas. And I'm wondering if we're going to see LMEs hit private credit as well, or if their documents and covenants are tight. Greg, Steve, up to both of you.
I'm happy to lead on LME. So I think this has been a fascinating topic over the last several years. In general, liability management exercises are also known as lender-on-lender violence. Basically, largely have emerged as an issue post-COVID, where you've seen this more of an accelerated convergence of the liquid in the private markets. That's resulted in more aggressive documentation in the private markets. And I think over the last several years, I'd characterize LME as negative surprises. So lenders in a given credit not realizing that the documents permitted certain types of restructuring activity, subordinating their debt, and that being kind of what the news or the emotion would be around it, was that it was unexpected outcomes. I think the court cases recently have seemed to be more minority lender positive. The Fifth Circuit case overturning CERTA bankruptcy that you refer to, Eric, I think very notable. It came out on New Year's Eve randomly, so I don't think a lot of people saw it. But in my mind, I think the shift is that I don't think it's a negative surprise anymore. Now I think market participants are aware of the provisions that can lead to this type of activity, and it's much more specifically negotiated for or not. And I do think that that's limiting it. I think that you're seeing, even though the market remains pretty hot, I do think you're seeing, certainly on the private side, intentional limitations on LME, more so than you were 6 months ago.
And on the private side versus the public side, sorry, real quick, Kevin, there is the difference of it's hard to have lender-on-lender violence when there's less lenders, right?
Absolutely.
And I think, but when you take that court case and you say, look, I think we probably have reached the peak of LME, it would be my opinion, but we will still see things that look like that, because whether it's the public or the private side, the option that's still available is for a third-party lender to potentially come in and look to lend against certain collateral. So look, these are people's businesses. They're gonna still look to do that. But I think to your question, has it probably peaked? Yeah, I think so. I mean, you feel any different?
No, I think your point is spot on, which is there was like an implicit protection if there's 3 lenders and they're all friendly with the sponsor and kind of know who they are. Again, as the private credit markets evolved, and now there are syndicates in private credit, probably not the same size as large syndicated loans, but it was always interesting. We've had a lot of those protections after each one of the cases happened. All those provisions have their name, right? There's a Chewy provision, there's a assertive provision, there's obviously the J. Crew provision, so they're all a little bit different, but they are in almost every one of our syndicated deals, and so we have that protection, but there are a lot of things in private credit documents that are tighter around things that the sponsor can do around incurrence of additional debt and things like that. So the two documents are a little bit different, but I think they are moving closer together because of this, because the private credit market has evolved a bit with so many new players, friends of sponsors that they kind of give allocations to, and then that's a great point, which is the exogenous third party that comes in and takes the collateral. So I think that's all moving the right direction, and I agree. The court cases, I was actually surprised by that. I thought the provisions would have held up, but it's all in all probably better for investors.
One other difference on this between the liquid and the private markets is that in the liquid markets, as a loan is coming under stress, it's of course trading. So you wind up with stakeholders in that loan that are pari passu with each other, but they have different cost basis. Versus the private lenders tend to be everyone's coming in day one, everyone's a par lender, their interests are more aligned just from a price standpoint. So in the liquid space, there can be more misalignment of the stakeholders as well.
Sure.
Yeah, I would add, so philosophically, we don't like LMEs. We're trying to create good companies at good prices, not steal value from fellow creditors. We also don't think it's a really good investing strategy, right? If a lot of these LMEs have been bridges to nowhere, and you emerge from a restructuring with more debt than you went into restructuring with, logically it doesn't make sense. And we've seen more than half of the LME companies have had a hard restructuring within the next 2 years. If you take a longer seasoning, it'll be more than half, by a lot. And recoveries have been low because of that. So we don't think it's a good strategy. Unfortunately, we think LMEs will continue. We probably agree that they have peaked in the US. But now the same advisors that did all the LMEs in the US are bringing it to Europe, right? So I think we'll see escalation of LME activity in Europe going forward.
And are LMEs coming to private credit? Like, does the documents allow for assets to be dropped into restricted subsidiaries or anything else that could really maybe challenge the clubbier deal of private credit?
We've seen attempts. We don't think it's widespread at this point.
Perfect.
Yeah.
Anne-Marie, I'm wondering how you're thinking about investing in these two disparate markets, kind of how it fits into the portfolio and how you're weighing up the risks of leveraged loans versus private credit.
Yeah, so we invest in both. Our private credit tends to be we have an allocation to private equity, private credit. So the amount of private credit that we're doing is actually based more on a bottom-up of whether we're seeing better opportunities in private equity versus private credit. And it's the same team that we have. And there's certain things we do tend to like private credit. We don't really like direct lending that much, but we do like some of the more special sits strategies that are doing creative things that might, depending on one's perspective, look a little LME-ish. So that's what we're doing there. On the more liquid side, we do have a high yield and a lev loan allocation. Those are more specific allocations that we have. And I would say there, most of our managers would agree with what was said earlier, that spreads are really tight. So most people, the two managers that we have both gone up in quality, not chased spread so much. And actually one of our managers is at their max cash position, exactly for that reason, because they think the opportunities are going to get juicier going forward. And then the third place that we do private credit is actually, somewhat ironically, in our hedge fund bucket. So we found specialty finance, so these are things that are 1 to 3 year paper, usually with an average, but amortizes, so it usually has an average life of less than 2 years. And so that we have put in our hedge fund bucket because we can do things that go out to about 3 years. We cap how big it can be, but that's been an area that we've been finding a lot of really interesting things, mostly because it doesn't fit into people's buckets. So the risk return is pretty attractive, and those are usually some kind of asset-backed. There's some asset behind them.
Any reason you've avoided direct lending or kind of shied away from it?
We, and not to say we have none of it because we have a huge portfolio, so we have a little bit of everything. We just haven't been that excited about the risk return. And to add a slight, it is also a space that has a lot of retail in it. And so we tend to have a higher cost of capital than retail. So anything where the cost of capital is lower, which borrowers should absolutely look for the lowest cost of capital, but it's just not attractive to us. We can find things that are more special sitsy, that are more interesting.
Perfect. Just on retail, we've seen, some of the biggest managers attempt to launch, public-private ventures. I'm thinking of Apollo and State Street's ETF. I'm thinking of what KKR and Capital Group are doing. Are you seeing this start to impact the market at all? I don't know if we're seeing actually private credit start to trade more frequently, or if it's having any real tangible effects.
I'm happy to lead. I don't think we're starting to see private credit trade more. Certainly not yet. There are efforts. I do think you need to. If we're talking about the word private credit gets used, I think, very broadly these days. But pre-COVID, I think it meant middle market direct lending. Today, I think it means large market direct lending, or direct lending of all kinds, as well as some private ABF, private real estate, and some special situations strategies as well. So it's a pretty all-encompassing term. I would say when we talk about tradability of private credit, largely that's referring to corporate lending on the private basis to large companies, sometimes investment grade. That's the focus for a lot of folks now, and sometimes it's the larger part of the sub-investment grade corporate market. It hasn't been real yet. There are some firms that put out, quote unquote sheets, but they're really not actionable on the buy or sell. They're kind of aspirational sheets, I would say. I do think that'll change over time. I think Kevin mentioned earlier, for some of these larger credits, corporate credits, whether they're investment grade or not, if all of a sudden you have 30 lenders in it, and including a couple of dealers, much more natural to quote that. And in some ways, I think that's the beginning, like almost you're seeing the restart of another broadly syndicated loan market in a way. I think over years that'll happen, but I don't think there's a lot of liquidity now. In terms of the products you mentioned, Eric, I guess I'd look at that differently in that I think some of those products are well suited to the growing need for alternatives in the retail systems, where what you've seen historically is in retail it's a very barbelled dynamic where there's a very small number of investors and financial advisors that are very heavy users of alternatives, and then most are at almost zero. And so a product that combines some liquid, high-grade product, kind of dynamic with more liquidity, with some amount of private exposure, I think that's likely going to, fit a need in the market.
Yeah, 100%. 2 years ago or so, the theme of this conference was spreading wealth more to the masses, and you have all these discussions with a lot of private equity and a lot of private credit and hedge fund, and all of that is obviously limited to sophisticated investors as we've moved more. And so the big discussion about there used to be 8,000 companies traded on the stock exchange, now we're down to 2,000. So your ability to play in traditional retail, just in normal markets, has just the growth in private across all the different asset classes, investment grade, equity, real estate, and levered credit and investment grade credit has created this need that if you're going to take some of this innovation that has some positive risk returns, to your point about the rate of return that retail investors might want, you kind of need to have access to it, even though that has a different set of risks, right? So I think that's something the administration and everybody else is going to have to figure out, right? Which is how do you get some of these products that are not regularly traded, more available to retail investors, and what does that then do to flows as we see that expand?
Right. Because the question really is, do you wind up with an asset liability mismatch, right? That's almost your question, right? And we hear a lot about private credit, and it's mentioned as, is there a systemic risk? And the answer, I think, to the point, there's not much in any kind of retail funds today, is no today, right? Because there's not an asset liability mismatch today. And then there's some access to this stuff through retail channels like BDCs. Anyone can go out and own a BDC, right? But that has liquidity constraints that don't make us, I don't think anyone, you guys interrupt me if you are, worried about that asset liability mismatch. And that's where the concerns potentially around some of the type of funds that you mentioned could come up. It's not trading today. I mean, I think probably the answer is there's nothing like a good crisis to get things trading eventually, right? And that's ultimately when people need liquidity is if and when this stuff will trade.
Perfect. Brad, just on kind of systemic issues, I'm wondering, yes, the banks aren't, you don't have that same asset liability mismatch, but the banks they have a huge business funding these funds. They, provide huge amounts of back leverage. I'm wondering if there's a risk developing there, or how you see that kind of filtering back into the financial system.
Yeah, and look, I think it gets to the other popular narrative on this, which is, the cannibalization and banks, sort of losing out on this business. It's kind of banks are just lending in a different way. I think you did hit it correct, right? Which is there's a deal that maybe traditionally would have gone, through a bank syndicated process, right? Maybe it goes to now a private credit shop, but then most private credit places are levered about a turn. And what do? They have that facility with a bank. I look at that and say, okay, what is better risk for a bank? Is it to be on the hook for the whole thing of a 6 to 7 times levered type deal? Obviously, it's a bunch of banks are on the hook for the whole thing, but just through the whole capital structure. Or is it better to have a pool of loans that maybe they're an extra turn of leverage on that pool of loans, and you're doing that lending at a 40% LTV? I actually think it might be less risky. I think there's a good argument that you can't get stuck, and look, very publicly, banks have gotten stuck with certain deals in the leveraged finance market over the last few years. We've had some instances recently. It's much harder to get stuck in that. And look, to Greg's point, recoveries have been a lot lower, but they have to be a lot lower and a lot lower on a broad swath of the universe to really take significant losses in that kind of lending. So when you're talking about one turn of leverage, I think back to the financial crisis, and you had banks providing total return swap facilities that were up to about 8 turns of leverage on, I was trying to be conservative here, on sometimes a single loan, right? It was usually a small pool, but we're just nowhere close to that. Like that.
Yeah, and I agree. If you think about the private credit, it's very hard to see a catalyst that will make the whole asset class unwind at the same time. So I don't think we're going to have a Lehman moment. I do think LPs should watch out for two things, right? So one thing is, unlike the public credit, where high yield managers run overweights, underweights, but overall their portfolios are very similar to each other, and there's not a lot of dispersion in the returns. I think we'll see significant dispersion between different direct lenders. And then the other part of it, look, if you don't sell, if you don't mark yourself down for 6 years, the tail end of the portfolios could be problematic, right? And it'll be a lot of post-reorg equity paper you just cannot refinance naturally, right? So watch out for the tail ends.
Yeah. What's interesting, I think, is that banks in leverage finance or anything we do in private credit, like banks are not asset gatherers around this asset class, right? So we gather deposits and make retail loans, and around the leverage finance business, it's always been that originate to distribute model, right? And so the goal was always so while private credit's come in and take away some of that underwriting fee, most banks go into leverage finance because then that gives you access to the client. So in a perfect world, I do think there's this good separation of needs, right, and kind of specialization of labor, which is you want to own the asset and we want to own the client, right? And so while we've set up a bunch of private credit JVs across different EBITDA spectrums, so we can kind of cover everything from lower middle market to mega cap between our sponsor finance business. We have a JV with a firm called Canal Road for upper middle market, and with Oak Hill for the larger side. That works out great. They own the asset. We commit a small amount so we can lend to them, do traditional banking business. And what most people get into leverage finance, we call it a BMO, the tip of the spear, right? You get in early, lend, There's all the traditional banking products you can do that direct lenders can't. I mean, that's one of the things that comes out of it, right? It's like you do a direct lending deal, but then you need to do a currency hedge or an interest rate swap, and then you're running around being like, I don't necessarily have a bank. So there's a lot of opportunities around just being a small piece of it. We do miss the underwriting fees that have gone to private credit, not gonna lie, but it does, on a risk-adjusted basis, you know, to your point, some of those go bad and you sit with them for a while, and then maybe you get them out later. But if you swap that out for then owning a pool of those assets that have a 40% equity premium or, you know, a 40% LTV, that's arguably a better trade. So again, most of the banks as they go into these JVs are really doing it to try to drive the one thing that is a little bit limited in a lot of the private credit shops, whether it's private IG or private leverage, is origination, right? The asset gathering's been great, but we have a massive origination force. Nobody really wants to pay for that 15 times over. A few of the larger private credit shops have done that. But a lot of people invest in it still need someone to kind of originate those transactions. So stepping in to be that and reducing the kind of tail risk you have of a potentially bad underwrite is actually, you know, on average, it's as safe or safer for the banks than it kind of had been when it was just a bank-dominated originate to distribute model.
Perfect. I want to come back to the bank partnerships, but just one question on back leverage. I'm wondering what kind of shock you'd need to create some kind of you know, issue for a direct lender. You know, what would prompt Goldman to pull Ares credit lines? Like what kind of depression would we need to get that?
Well, I think you've seen, you had a little bit of a test with this, with COVID. That's obviously was not a credit cycle, but it was a massive shock where an immediate credit cycle was the fear. And so in the wake of that, you saw how bank lenders to these types of pools would behave. And largely you didn't see a whole lot of stress or pulled bank lines is the short answer. So now that was a very immediate shock that, you know, then the market kind of, you know, if we all go back to those days, not that we want to, but by September, October, things were already thawing out, you know, on the credit side anyway, in the capital markets. But the immediate response wasn't that drastic. I think if you know, maybe Brad laid out, you know, these facilities tend to be kind of one-to-one levered. They tend to be against first lien assets that, you know, historically default and recovery rates are, you know, maybe 2% default and call it 60% recovery. Maybe recovery rates are lower today, but you would have to have, you know, well over 50% defaults for there to be a real issue of the bank losing capital in those structures. So that's why I do think it's a good marriage, as the panel is saying, of, you know, kind of the alignment. Like, banks have not left the leverage finance space at all. They're in it in big size in a second loss position. That's actually, I think, you know, very good risk-adjusted return for them. Yeah.
If you think about when unwinds did occur, say in the financial crisis, right, of those type of facilities, the much higher lever ones I mentioned, you know, you had bank loans down 30 plus points, right? And therefore the answer was, well, when would you get blown out of the line? You would get forced out of it when you couldn't post the collateral, right? And so that's the simple answer. And the likelihood of that happening, right, is something that's only a turn of leverage and is on these assets that aren't being marked to market in the same way is a lot lower. So if we think about COVID, I think the lows in the leverage loan index were, someone correct me if I'm wrong, 77-ish or something like that, right? Whereas on, you know, most, like if you look at BDC assets as a barometer, was probably around 90-ish, right? And so some would say, okay, they're not marking it appropriately, but the flip side to that is there has to be a chunk of that move to 77, which was people were selling because they needed liquidity, not purely because of fundamentals, right? You were getting massive outflows from daily liquidity funds that are a huge part of that. And so, you know, there's puts and takes. I think there's arguments that maybe, you know, things should move a little bit quicker on the private side, but the answer is probably not that it should move as quickly as that leverage loan index. And because it's not moving as quickly, the likelihood of having to post significant amounts of collateral that lead to unwinding of lines is a lot lower.
Perfect.
No, I'm sorry. I mean, it's simple math. The equity account in these lines is basically set to the 20-year average of recovery rates for senior secured loans. So again, assuming you just run through the math, assuming either half the portfolio or 3/4 of the portfolio defaults but gets an average return, you're still covered by the equity. So they're well structured. We'll see as demand increases
Are
for
you though?
that.
Because if you're using a 10-year average recovery and recoveries are half what they were compared to that average.
Well, again, so inside that, you have a bunch of the LMEs that are zeros, and all those averages, when we go through them, they end up being, right, you can run through some that go to zero, right? It's always the classic math. If something can go to zero, that dramatically impacts the average number. So when you run through names by names, I agree, there's been a couple of those that have been just straight liquidations, which is hard to average a bunch of zeros with a bunch of 70s and get to something that's not much lower than that. But yeah, so we have looked into that. So as long as you avoid the true like liquidation zero recovery deals, which there have been a few, and again, if you avoid, which we're happy in private credit, you are going to put some of those terms in there around no LMEs and getting rid of the lender-on-lender violence, because those are the ones that have really dramatically impacted recovery.
It's very hard to see the unwind of this leverage in a vacuum cause a crisis, right? The structures are a lot more soundproof than they used to be, right? So it has to be some external shock, financial system shock. This is not going to be the cause of it. It'll be an effect of something bigger happening.
Kevin, how are regulators thinking about this? Like, do they understand? Are they comfortable with how this leverage is being used? Are they asking more questions?
So I'll break. So, you know, one of the we've talked about this, the use cases for private credit, right? And I think for clients and borrowers, private credit has become a great opportunity set because there are great use cases, right? So banks tend not to really like to lend on high leverage to small or mid-sized companies, and so there's rules around that, but there are some really dedicated lower middle market private credit shops that specialize in that and do really well, so that takes some of the risk out of it. There's an entire case of, we were talking about this, around leverage lending guidelines, where these 7 to 8 times deals are just, we can't do. And so in some ways, the regulators are very happy that there's a private credit outlet for that that's not in their backyard, quite frankly, right? It's not the bank regulators that don't regulate the private credit asset managers, so they just let them do that. But there's been some great case studies. You mentioned the Boeing software deal, Jeppesen. That's phenomenal credit that got leverage that's way beyond what a bank could do. So, you know, they obviously constantly ask about it. They ask about, and then they do get into what are the knock-on risks around that. We get great credit. Again, there's a lot of things on banks' balance sheets that are structured like this with different asset classes, right? It's, you know, it's the basis for the structured credit market, and it looks similar to that. These have been vetted and run through. Some of them get externally rated. We have sold on some of the private credit financings we have. We've sold the actual debt portion of that also. There are investment grade buyers and insurance companies that look at that as a positive rate of return. So like with everything, the regulators you know, are nervous about, you know, exuberance and things getting out of control. But generally speaking, keeping the most highly leveraged credits for LBOs off bank balance sheets and distributed immediately, and then recreating some of that into these structured credit vehicles that are similar to what we do for a lot of other things, you know, to kind of keep the velocity of lending going. They're okay. So we haven't had, again, they ask a lot of questions. We're extraordinarily compliant as you need to be. It's a no-win situation for that. So, but for the most part, it hasn't been.
Yeah, I mean, I was going to ask Emery, for you.
So if certainly Treasury Secretary Bessent was here and he was saying less regulation. So if the regulators come out and say you can do those 8-time deals, you going to start doing them?
That's a hypothetical on a hypothetical. I also don't know if that's the, so yeah. So who knows? Who knows? But the question is, I don't know, when you talk about bank regulatory, I don't know if you get down to leverage lending guidelines. I think when you start talking about capital adequacy and how they calculate that and excess capital, that's more of it. If we get to the point where Trump's tweeting about leverage lending guidelines.
But I think the capital adequacy is a good point, because implicitly they have been fine with it, because the way they've set up the capital rules, right, it's still going to favor us doing, you know, financings and doing, and this is where it's probably a better question for you, honestly, right, because you're, I'm sure, being shown things like senior risk transfer trades, right, and so the capital guidelines, which I think are gonna, yes, they might get a little bit more lenient, but I don't think they're gonna lean in the favor of doing 8 times levered deal, to Kevin's point. They're gonna lead to probably, yes, taking more risk in areas and then trying to offlay it and do more of that, right? And so I think what we wind up with is, to your first question, yes, implicitly, regulators, I guess, are okay with that, what's going on now, because what they're doing is moving us in this direction of financing and then probably showing people like you SRT type deal, right?
Yeah. I am just wondering, just on that point, even with banks keeping kind of, to the leverage lending guidelines, in March, when markets gapped out, we did see a number of hung deals again, just after banks had cleared their Twitter exposure and kind of everything else on balance sheet that had been hung from 2022 and 23. I'm wondering if folks are kind of comfortable taking this risk, or actually they think the 6.5 times really is where they should cap out.
I mean, every credit is different. I don't know the deals that, not necessarily every deal that got hung was because the leverage was too high, right? So there was transactions directly impacted by tariffs. There was that 2-week period where the market completely fell out of bed and there was just no new issue getting done at all. We're back to that again. So yes, I think a lot of banks felt that was a temporary pause. You have to then reevaluate and re-underwrite your credit to figure out if it's actually, was it impacted in that time frame because of credit outputs and what's going on and uncertainty around the economy, or is it just simply the entire buy side of the market just started looking to the secondary to buy things cheap that they already own, right? Like I went back to my earlier point, when you get down to the average loan index, when the loan index is trading around 95, no one wants to buy a new issue because the entire secondary is for sale, and that's the things they kind of know. So we're slowly moving back up again where we currently are today. So yeah, the bigger issue, so the market in our view will heal itself because what happened in the last 2 weeks has also created a lack of new supply. Right, M&A has been the lack of M&A over the last 2 years has probably been the biggest story for all of us in credit. And when you start talking about credit spreads tightening or being too tight and there being too much money chasing too few deals, like the creation of the demand for assets that's been through all this fundraising has just not been met with the M&A that we all thought was going to happen. We talked about that following the election. We thought it was going to be fantastic, and then we get into this year and it continually gets pushed over. So there's not a lot coming. So banks are still open from our perspective and still underwriting. There's just not a lot to underwrite, and if it does get underwritten now, it's probably not coming to market until post Labor Day. So you have this period of time where the market can reevaluate, absorb, understand what it owns, hopefully tend to trade that up as the market grows organically with interest payments, and then we come back. So yeah, that was a temporary pause. It was different than if you take back to the time of COVID, everything shut down and the market kind of ripped back again. This feels different than that, but it certainly doesn't feel like the full unwind of the structured credit trades that we saw back in the crisis.
But the answer to Anne-Marie's question, I think, on if banks would like to do 8 times levered deal, and I'm sitting in the research seat, not the capital commitment seat, obviously. But look, as someone who spent a lot of his career as a credit analyst, we've got a process the same way Steve would, the same way Greg would, right, around looking at these deals. And I think the frustrations that banks have often had with leverage lending guidelines is a somewhat capricious nature of picking X turns of leverage is where the problem is. And it's Fed day today, right? Interest rates are high on floating rate debt, and the answer to what leverage a business can support today is probably a lot different than at other points of time when interest rates were a lot different. And so, yeah, I think they'd welcome a little bit more flexibility, but I think there's still plenty of things we pass on today that we think we could legally do.
Mm-hmm. I think the bigger issue. Sorry, just one. The only other correction we have for some of those things is right now, one of the major limiters of being able to distribute anything is ratings, right? And so no one likes to say that they're protected by the rating agencies, but we start running ratings models where you get to a certain leverage level and it's no longer B3 and it's below that and it's just not syndicatable, just given where CLO buyers are and most other buyers are. So yeah, to go back to the Jepson deal, everybody who looked at Jepson, phenomenal credit, would sell phenomenally. Those are the kind of deals you're like, I wish we could do that, but we can't. So you just kind of move on. Sorry, Steve.
No problem. The point I was going to make is just to think about the different structures of banks versus, let's call it, alternative investors and the role they play in the markets. So, banks are in today's world, about 10-to-1 levered. A lot of their debt is in the form of on-demand deposits, right, which are viewed as non-risk-taking interests, really, by everybody, versus alternative lenders. If you want to look at the BDC or a private credit fund that may be 1-to-1 levered, and the risk takers there are actual risk takers. They're seeking return for risk. And so if you think about, an 8 times levered loan, it doesn't really fit the bank structure or presence in the space, especially if it's unrated. Banks are somewhat rating sensitive, not completely. And I think that's hopefully one of the main lessons learned from the financial crisis, where banks were getting up to 30 times levered and not really respecting depositors as, kind of not really looking to be taking risk, and they're short term. They're also quite short term. And so I think for that reason, and as Brad mentioned this, I don't think regulations get to the point where that 8 times levered deal is now what you want to do. Yeah. I think and these leverage facilities that we talked about, we talked about 10 years, they're 3-year facilities. They're 3-year revolving facilities, and then they go into runoff for a couple of years. So that really suits the bank capital. It's shorter term, it's less levered, it's still a very nice return over their cost of funds. And I don't think that dynamic is going to change. I think a lot of the kind of alternative capital that's come into play post GFC, is really post GFC that a lot of this alternative lending got really institutionalized and scaled. I think it's been a healthy reallocation of risk away from depositors and to intentional risk takers.
And the other governor, right, away from the regulators, away from management teams, it's the shareholders, right? So if you look at the bank shareholders' experience over the last 17 years, it's not been great, right, most of the time. So you could see how they're just going to punish banks who are becoming too risky.
Well, it also feels like banks have struck a number of private credit partnerships over the last few years. They're keen to tackle this market. Right, we saw the Citi Apollo deal for Jeppesen. But in our reporting, it seemed like there was a very clear shot that actually Apollo was going to lose the deal to Blackstone, just given how much competition there is amongst private credit lenders to lend. So I'm just wondering, with that as the kind of background, how successful these partnerships are, kind of what the mile markers you're looking at, and why maybe we haven't seen more activity from these.
I mean, there's been a ton of activity. I think we talk about private credit's got a bunch of definitions, and then these joint ventures also do. I mean, there are programmatic SRT trades where there's just like an offlay of like investment grade risk to an investor that they'll call a JV, but it's not really proactively going for it. We've set up, like I said, we've set up two different JVs in our institutional private credit market, and then our middle market private credit business, where we underwrite and then we have SMAs and investors who treat us as the asset manager to get off that risk. So again, the goal, this goes back to, none of the banks want to do the 8 times deal to hold the 8 times deal to get NIM on the 8 times deal to benefit their depositors. That's not the trade. It was always an originate to distribute model. So on transactions like that, I think finding a direct buyer who's going to take that risk makes a lot of sense. The JVs, they take a whole bunch of different forms, but again, I think the primary goal, and we'll see more of this, is borrowers need banking. They need capital for whatever their strategic need is, whether that's an acquisition or some other strategic initiative in growth. But they also need traditional banking businesses, and so that's kind of the only thing that they're missing in some of these private credit deals, which is I have investors who actually want to hold the debt. They usually have a personal relationship with them, but then they kind of need somebody else to do M&A, equity, hedging, traditional banking services. And so that's how we treat our JVs, which is, we have over, approximately $20 billion kind of allocated across a bunch of different things between financing and SMAs and things that are on our balance sheet that ebbs and flows with repayments and the like. But across that is a whole bunch of borrowers that we want to just service that borrower for their banking needs. And so it's not, the future is, we have to determine how it's all going to work out, because we've done that for, covering the company so that when they go public or when they sell, we're the advisor, since that's the business that we love to do and asset managers don't. The problem is we haven't had it much in the form of sponsor-backed IPOs over the last couple of years, and there's been a slow M&A market. And so I think we'll see more of those come out there. I think certainly smaller startup-y kind of private credit, private lenders want bank JVs because they need that origination machinery, right? No one wants to build out a coverage universe that's different than what they currently have. And so we'll see that move on. So the jury's still out. They're very successful. They've been a big piece of us gaining market share, because when you have markets like this and private equity sponsors are like, I don't know if I want to go syndicated, and I don't know if I want to go direct, because the markets are a little bit in flux right now. We had a market for the last year and a half that was pretty much pro-syndicated. There's only a few banks they can go to that can give them opinions on both. And so that part of value service to our clients, which is make one phone call, get a syndicated read, get a private read, you get to pick. We're kind of agnostic at some level of, well, we make more fees if they do syndicated, but we still just want to make sure we're servicing those clients. So I think we'll end up seeing more of those. It's surprising to me that some firms have not done it. I think the list of potential partners out there that are value added from the asset management side are doing, and some people are building their own origination platforms. But I do think we'll see more of it, just because the demand, like as we're going through, there's so much capital chasing so few assets. Having access to the sourcing of those assets, is taken on a lot of importance for the investors, and we want to meet that demand for them as well.
Perfect. Yeah, actually, on that point, we had a question come in from the audience, and they're wondering, they were kind of surprised by the fact that folks think LMEs have peaked. They say there's so much capital chasing so few deals. So shouldn't covenants loosen, and shouldn't we see more LMEs in the future? Greg, do you want to take that?
Sorry, I couldn't hear the question.
More LMEs in the future, given how much fraud.
How much capital there is out there?
Yeah.
Yeah, look, I think Brad made the point, right? The creditors expect LMEs now, and they get ready early, and they sign co-op agreements. Some of these co-op agreements include 100% of lenders, right? So once you sign something like that, it's hard to be violent, right? I think the sponsors also, they're becoming very conscientious about their reputation in the leveraged loan market, and you see a lot less, in 2022, 23, you saw a lot of third-party money LMEs where the existing creditors were really disadvantaged. You don't really see those anymore, because the sponsors really want to work with the existing creditor groups. They want to be able to bring new deals to the market, right, and not get penalized on the higher interest rate. So yeah, it's not going to go away, but it's probably near a peak.
Yeah, I do think it's going to morph a little bit, and we're going to start to see less distinction between what's an LME and what's just a workout restructuring of debt, right? So I think the big question is, what's our economic backdrop, and if the economy's not great and rates stay high, which are big questions, right? That there was a lot of debt raised in the 2021 timeframe, which was very cheap. And so as that debt comes due, it's going to have to be refinanced. And if rates don't come down, it probably can't be refinanced on the terms or the structures that exist today. And so is that an LME? Is that a restructuring? Is that just a private credit and private equity team getting together and restructuring things? I mean, I think it's all going to morph, and because so much of it's going to be in the private credit space, you're not really going to see it. It's going to be kind of, it won't be like you were talking about during the financial crisis, where we could say everything was at 77. So, things will be marked at par, and then, oops, we just didn't hear about that one, and now we're back. And so I think it'll be a lot more, and I actually think that's good, right? Because that's a better way to work things out gradually over time, collaboratively. But
Yeah,
we're going to have to do a lot of work over the next
To Anne-Marie's point, I think people will get a lot more creative as we tackle this maturity wall and the higher default rates. And some of it will be, people like us who buy secondary debt at discount and then work with existing original lenders who don't sell. And we're going to equitize our position and become the new equity of the company, and the existing lenders are going to roll their exposures. We've done 3 transactions like that in the last 12 months, right? So we think that's a model that's going to work.
But I think a lot of these dynamics are reasons to believe that there will be more restructurings and workouts and winners and losers from those, versus maybe the question getting at, will there be more allowance for LME in documents, and maybe distinguish that point. And it does seem right now that there's just such a spotlight on the specific provisions that allow for LME that those provisions will have, maybe that's what's peaked, is the development of those provisions, but the use of what exists probably has not peaked yet because of the maturity wall.
Got it.
Yeah.
Anne-Marie, you touched on marks. We've written about this a ton, just around Pluralsight in particular, where many of the banks were holding it around, or sorry, many of the direct lenders were holding it around low 90s, somewhere close to par, and then very quickly it just fell right off. I'm wondering, do you trust marks when you're seeing them in your private credit portfolio? Are you due diligencing them differently? Is there just an implicit haircut that you put on them when you see them come in?
So I'll make 3 comments about marks. One, I always love this debate, and I have a public equity book. I'm responsible for a public equity book in addition to a private equity book, or private corporate book. And I find it fascinating when people are like, do you trust the private marks? I'm like, well, when your lev loans were at 77 and 3 days later they were at 80, or 85 or 90, is that mark real? Yeah. So is there a lot of discretion? Yes. Are some people overly optimistic? Yes. I would argue probably less so in the loan space, but in the private equity space, people are also overly pessimistic sometimes, right? They don't always want to write things up when they should. So that's one thing I would say about it. Second, specifically to the question what we're doing, we haven't done a lot. We've always, when we underwrite a new fund and when we're monitoring funds, we're always looking at the marks. We're doing some work around how good we think they are. But in some ways, we don't worry about it too much because as long as nobody's collecting any carry until something's been realized, we don't care that much, right? And that is one of the beauties of private credit, is that you match the duration with the duration of the loan. The third thing, though, that I will say is as these retail products become more available, if you think about interval funds, BDCs, but interval funds are probably the best example, right? Where somebody's buying in on a monthly basis, then the marks really do matter. So I do think there will be some, or there needs to be some evolution in how things get marked. Maybe third-party marking services. I don't love that because then it's another layer of fees I got to pay for. But I do think there's going to have to be some evolution as this stuff becomes more liquid-ish.
Right. Does the push by Apollo to get these into ETFs and get them moving, does that solve a problem? Does that do you want to see these trading so that you can actually get some proof?
No, I'm not a big fan of this ETF. And going back to the earlier comment around illiquidity mismatches, I'm actually much more worried about it. So this ETF, I think, well, we can argue, is there a liquidity mismatch or is there truth in advertising? Because I think they only have 15% in private credit that you get, right? So is that really private credit? But over time, yeah, a lot of this stuff is going to have to get formalized in a way that's better than what we have today.
Steve, just turning to you, do you want to see this trading as a private credit manager? Is it problematic if you're starting to see loans move?
Well, I think liquidity in general is good. I think that kind of inaccurate pricing is not good, and Anne-Marie's comments kind of get to some of this. I think that when I think about the private credit market, the largest loans, we talked about this a little bit earlier, the largest loans that are going private, so you might have a $2 to $7 billion loan that goes private and is syndicated across dozens of investors. I think that's more valid to quote, if you will, or to trade. I think that the historic business of direct lending, where you might have a $200 million loan facility and 3 lenders, I don't foresee that ever being a liquid product or trading in any sort of real way. So I do think you're going to see this very different ecosystem of the largest part of the capital markets that is using private solutions for structural flexibility, for customization, for things of that nature, that over time I think is more valid to have kind of, real trading levels on, versus the historic market, which is really a market for companies and products that don't have access to the capital markets, that I don't think you'll see that in. So I think it really is product dependent, and I think you're going to see different ecosystems. So it's not a matter about wanting it to trade or not. It's more about what is really valid to price and to trade versus to have more of a third-party pricing service, which is how a lot of private product get handled today.
Excellent. Well, with that, we're right on time. So thank you everyone for joining today. I really enjoyed the discussion.
Thank you so much.
Thank you.